Hey guys, it's time for another dividend income update video, and this one we're going to look at the month of January because I received 7 dividend paychecks. Today we're going to look at how my portfolio is performing, what were my buys and sells, how much I got paid in dividends, and who paid me those dividends. I'm actually quite excited to share these numbers with you guys because I can always see that my portfolio is moving, whether it's up or down, and then I can also see that my paychecks are growing. But aside from that, I can share with everyone that dividend investing works and it's a great way to create passive income. Anyway guys, if you are new here, my name is Dred and I post personal finance and dividend investing videos and pretty much anything related to money. But right now, I am documenting my journey in paying off my student loans. So if you're interested in seeing how everything unfolds or just want to show your support, then please consider subscribing to the channel, liking this video, and also sharing this video. Now, without out of the way, let's get back to the main thing. Here we are on the dashboard of Webull. As you can see, my total account value is $7,945.93, and it's basically a gain of $275.50, or a 3.61% gain. I still have a cash balance of $35.98, so basically I can buy some other dividend stocks that I would like to buy for this month. So let's take a look at my positions right now. As you can see, I have 16 positions, which is basically a bump up from my 15 before. So the first one we have right here, as you can see, we have Stag, we have O, we have ABBV, we have Good, we have EPD, we have SCHH, and then PDI, which was PCI before, and then we got main right here. We have LFTRT, which I will talk about briefly later on, and then we have ONL, ABR, NYCB, Store, LFT, GNL, and T. And if you're looking at it already, it's already sorted out via winners and losers. So the bottom 5, we have at&t as the biggest loser. Then next is GNL, LFT, Store, and then NYCB. And then our biggest gainers or biggest movers ever since, we still have Stag right here as the winner. It's a gain of $436.32, or a 40.29% gain. And then we got O with $99.37, or a 12.42% gain. AbbVie is the next one, 88.41% dollars in gain, or a 26.38%. The next one is Good. We have $71 at least, or a 7% gain. And then EPD, finally, we got $34 of gain, or a 7.76% gain. So those are the top 5 and the bottom 5 of my portfolio right now. So let's take a look first at my buy history and my sell history. I actually only did 2 buys for the month of January. Let's just filter this out real quick. And there we go. Like I said, I only have 2 buys for the month of January. First one, we got O right here. Let's take a look. I bought 2 shares of O here with a limit price of $67.95. I believe this was kind of like when it was going down. So, I was really buying more in the dip actually. Anyway, let's go back to the next one right here, PDI. And this is, by the way, on the same date as well with O. At a limit price of $24.80, I bought 5 shares of PDI. So all in all, my buys for January kind of totaled to $259.90. So $260, pretty good buys actually, because I've already started kind of like contributing $200 into my portfolio, which was pretty much my goal really. So there you go. This was basically the start of that. So I was able to buy more this month compared to my previous months where I was only, contributing $100. Then if we look back to the assets section right here, again, I still have like $35.98 or like $36 that I can actually spend. So I'm gonna use that one for February. So anyway, let's move over to the dividend paycheck section right here. Let's go to history. Let's take a look at the dividend records, filter that one correctly with January 1 to January 31, and done. And then we got 1, 2, 3, 4, 5, 6, 7. There you go. Correctly, I said 7. So 7 dividend paychecks for the month of January. So the first one we got here is Main Street Capital, ticker symbol MAIN. On the 13th of January, I got $1.51. The next one is on the same date as well, Realty Income, ticker symbol O. I got $2.71. And then the next one is Global Net Lease, which is GNL, on the 17th of January for $31.20. So basically the biggest payer for the month of January. The next one, same date as well, is Stag Industrial, ticker symbol STAG, or just Stag. I received $4.35 for this stock. The next one is still on the same date, on the 17th, Store Capital, ticker symbol STOR, or Store. I got $1.93. And then the next one is Lument Finance Trust on the 17th as well. So I got a lot of payers on the 17th. Ticker symbol LFT. I got $2.25. And then lastly, On the 30th of January, I got Gladstone Commercial, ticker symbol GOOD or good. I got $5.89. So overall, it's a pretty good breakdown on my dividends. 7 dividend paychecks. The highest one is $31.20, and then the lowest would be $1.51, which is totally okay. You know, basically my goal right now is to kind of like keep on growing those dividends, you know, keep adding more to either my REITs, and if REITs basically become too expensive, I'll move on to other sectors. But there you go, those are kind of like the breakdown for my dividends. If we total everything together, I earned $49.84 in dividends for the month of January. So I want to talk about two stocks here, which is the LFTRT and then at&t here. So let's go over to my asset section right here. Let's take a look at the LFTRT. So when I actually saw this one, I think like 2 weeks ago, it was quite confusing to me because I don't know why this happened or what this was. Apparently, LFTRT is a transferable rights or rights offer by LFT. So let's take a look at their news right now. So this article is from Yahoo Finance. It says Lumen Finance Trust Inc. announces transferable rights offering. Now, to be honest, I really don't know what that meant. I'm not an expert in stocks yet. So there we go. I just look at the news sometimes. So let's take a look at this one. LFT announced today that its board of directors has approved the terms of a transferable rights offering to purchase shares of its common stock. Wells Fargo Securities LLC and JMP Securities, a Citizens company, will act as dealer managers for the offering. We expect this offering to be a transformative equity raise event that will provide us with the growth capital necessary to further our objectives of achieving appropriate operating scale and expanding our capacity to make investments in target assets, said James Flynn, CEO of LFT. As a result of the offering, we anticipate that our general and administrative expenses as a percentage of stockholders' equity will decrease. We also believe this transaction will increase the liquidity and trading volume of our common stock. Mr. Flynn also noted we structured this equity raise as a rights offering to allow existing stockholders an opportunity to participate meaningfully in our growth by subscribing to purchase additional shares of our common stock at a discount to the market price and avoid ownership dilution. An affiliate of our manager has indicated that it intends to provide meaningful support for the offering by exercising its oversubscription privilege and making a total investment of up to $40 million. In addition, Hunt Companies Equity Holdings LLC expects to exercise its oversubscription privilege, and all of our directors and executive officers intend to exercise in full their rights. There we go. We continue to believe the company's investment strategy is well positioned in the current environment, and we expect to continue to differentiate ourselves from our peers by leveraging the breadth and expertise of our manager's platform to create long-term value for our stockholders. The company will issue to stockholders of record as of 5 p.m. New York City time on January 18, 2022, transferable rights to subscribe for an aggregate of up to 37,421,825 shares of the company's common stock. Each record date stockholder will be issued 1.5 transferable rights for each outstanding share of the company's common stock owned on the record date. And that's why my 25 shares of LFT kind of like received 37 shares of LFT-RT. The company intends to apply to list the rights on the New York Stock Exchange under the symbol LFTRT, with trading anticipated to begin on or around January 19, 2022. Rights may be exercised at any time during the subscription period, which commences on January 19, 2022 and ends at 5 p.m. New York City time on February 11, 2022, the expiration date. So that's pretty much, I think, the main issue right here, or the main story, is that they're doing the transferable rights. To be honest, I personally don't know what that is. You know, I tried reading more of it and kind of like understanding what it is, but it just didn't stick to me as of yet. But that's it. That's the news. Lumen Finance Trust announces transferable rights offering, and you know, if you have LFT on your portfolio and you know you're kind of like surprised that you also got some sort of like new stock, LFTRT, then this is the main reason why. So the next one that I want to talk about is at&t, and I know a lot of people have been kind of like curious about what's going to happen with at&t. So let's take a look at at&t right now. Let's go to at&t. Let's take a look at some of the news that we have right here, because if you can see their charts, it's pretty crazy. It's just really going down. You know, they actually went up a little bit probably around the middle of January. I was very surprised when I took a look at my portfolio. AT&T kind of like passed over GNL, which was crazy. GNL for a short time was the biggest loser in my portfolio, but then, AT&T took it back again. So there you go. It's kind of crazy. So from my average price of $32.29, now it's down to $24.56. So let's take a look at the news. So we have another article here from Yahoo Finance. As you can see, with spin-off, AT&T picks safer exit for Warner Media. This probably came from Variety, but anyway, now in the home stretch of unloading Warner Media, AT&T John Stankey appears to be primarily interested in not destroying any more value for shareholders than the telco giant already has with its ill-fated M&A strategy, which is pretty much the main reason why it has a lot of debt. They've been acquiring different companies that haven't been, fruitful for them, unfortunately. This week, AT&T announced that the Warner Media divestiture will be structured as a spin-off ahead of its combo with Discovery. That will give telco shareholders pro rata shares in the newly created Warner Brothers Discovery, as the new company is to be called. So it's Warner Brothers Discovery, which is interesting, They really didn't, take the time to create a new name. Anyway, Stankey and the board had been mulling a less conventional exit, a split off of Warner Media, which would have forced AT&T shareholders to choose whether to keep their shares in AT&T or exchange them for stock in Warner Brothers Discovery. The goal with a split would have been to reduce AT&T's outstanding share count, tantamount to a stock buyback by the telco. Analysts say a split off would have effectively been an immediate referendum on Hollywood's streaming ambitions, one that AT&T now avoids by doing a simpler spin-off of Warner Media. It's safe to assume a good chunk of AT&T's retail-heavy shareholder base would not have wanted to trade their stakes in the telco, which pays out an annual cash dividend, in favor of hopping on board a volatile Netflix-like roller coaster, which is kind of like makes sense, rather than go to Netflix, which has been crazy actually. It's better to just ride it out with AT&T because it's a safer play. I don't know. HBO Max has been doing well, don't get me wrong, says Keith Snyder, CFR, a research telecom analyst of the company's streaming arm, but the new company will have lots of debt and require a lot of capital, and with a weak balance sheet, they're going to be fighting in a really competitive streaming market, which is very true because Disney Plus is kind of like, trying to break that. They want to be in the streaming wars, obviously, with so many movies that there or content that they've kind of like published and put out there that have been quite, very good, especially with Disney's Encanto. That was pretty good, right? So if you watched that one, shout out to you. But anyway, shares of AT&T dropped 4.2% on Tuesday as the telco also announced a dividend at the low end of its $8 billion to $9 billion previous guidance. So this is it, guys. If you have been holding AT&T, it's going to get cut. So that is something I'm actually planning of maybe cutting it in half, my positions in AT&T, but who knows. AT&T expects the Warner Media spin-off and merger with Discovery to close in the second quarter of 2022. Previously, it had pegged the close for mid-2022, with Discovery CEO David Zaslav set to helm the new media conglomerate. Per industry chatter, the parties think the transaction could close as soon as early April, though that depends on the Justice Department giving it the thumbs up. The spin-off distribution will let the market do what markets do best, Stankey said in a statement. We are confident both equities, AT&T and Warner Brothers Discovery, will soon be valued on the solid fundamentals and attractive prospects they represent. At the close, AT&T expects to reap $43 billion from the deal, a sad return on its foray into the media biz after buying Time Warner for nearly $85 billion. So they're getting it like half. So that's kind of sad, So like they said, their M&A strategy has been really bad. At the same time, the new WBD plans to assume up to approximately $43 billion of additional debt. AT&T aims to use the proceeds from the Warner Media spinoff to pay down net debt, which stood at $156.2 billion at the end of 2021. So as you can see, this is the main reason why a lot of people have been kind of like disappointed with AT&T recently. Their debt is just too crazy. They've been acquiring all these companies with almost like no thought to it. Well, don't get me wrong, and I don't really know much about the story about here, but the way that I'm seeing it, it's almost like that. It's just like they're buying it for no reason almost, or they're too optimistic about their buys. Anyway, AT&T is one of the most heavily debt-laden companies in the United States right now. They need every single dime, says Snyder. The spinoff is the final major step in AT&T's plan to slim back down to a pure-play telecommunications provider. So there you go. This is pretty much their main goal, to go back to their main business, which is telecoms. And I think that is actually a good play. They should actually focus it on it before they move on to something else, because they're not really good in something else. That's been proven so far. They're not really good with the media business. They're not handling it really well. So focus on their, communications business, and maybe from there they can offshoot different telecom products and services, and it'll be a lot easier for them to kind of grow their balance sheet again. But anyway, those are the two stocks that I wanted to talk about for this video. And for my final thoughts, the start of 2022 has been quite a rocky start for the stock market, which is obviously been crazy. A lot of people have been seeing their portfolios kind of like dip or lose a lot of value, and I see a lot of investors as well selling off some of their position, a lot of their position, and maybe even entirely closing their portfolio. There are so many things happening in the market right now that personally I checked out from watching, reading all the news, and even looking at my portfolio. I really started to feel overwhelmed by all the negative news, all the stuff like that, the market crashing, people need to get out of it, etc. And while I may have distanced myself a little bit from all those negative news, all those chatter, all those talk, I did pick up a little bit of like gold nuggets from those news. I would listen to it. I wouldn't kind of like mull too much on like the negative side of things. I would just like I said, get the gold nugget out of it and then kind of like apply it to my portfolio. So even if almost everything is going down, I pretty much bought the dip instead. I finally was able to add $200 to my portfolio, and like I said earlier, I've been buying up different stocks. I was able to buy more of stocks that I like, and that's pretty much the plan for this year, and pretty much for February, just gonna start buying different dividend stocks that I need or that kind of like aligns with my plan. Basically, I'll just be buying more REITs, and if REITs become too expensive, then I'll move on to different sectors such as financials, maybe consumer staples, or maybe even telecom. If the market continues to act like this, I'm just going to DCA my way into a sizable position for my REITs, and if REITs become too big in my portfolio, then I'll kind of like redivert that one to other sectors. That way I can start diversifying again and kind of like avoid any huge swings in my REIT positions. To be honest, I'm not sure when the market is going to recover again, but as a dividend investor, I'm always looking at it long term. So my focus is always on building my portfolio and growing my dividend paychecks every month. And that's all I got for you guys. Thank you so much for watching the entire video. I hope you find that helpful. I hope you find that informative. I don't know, let me know in the comments below. If you have any suggestions for me, let me know in the comments. And also, if you like content just like this one, please subscribe to the channel, like this video, and also share this video with a friend of yours. And also, if you're on Instagram at Daily Dread, please add me there as a friend at Daily Dread so that we can chat, collaborate, and maybe even exchange some ideas. Thank you again so much for watching the entire video. Have a wonderful day, and I will see you in the next one. Bye!